Okay, hello everybody. Welcome to Korean Latin Mentorship. And in this video, we're going to talk about the topic of whether owning a home, a personal home, is a good investment or not. So I put this search result into Google in a incognito window so I can get the most unbiased search result as possible. And so if you look at the top search result, it says, in the long run, owning a home is a good investment. And that's Google highlighting this, not me. When you rent, your money goes to the landlord, whereas when you put your money toward a home, you can see the return over your investment on your investment over time. And that makes sense, right? Like when you go pay money to a landlord to live to a house, you don't get really anything other than the right to rent the house. Whereas with your homeowner, there's going to be equity that eventually gets built up. So here's the thing. When we're real estate investors, we always have to do just the basic math, right? And a lot of people fail to do the basic math, but that's what we're going to do in this video. And another thing I kind of want to mention is that, yes, even though this is the top search result saying, hey, Rocket Mortgage says it's good, and maybe they have a financial interest in telling it's good, I don't know. If we scroll down here, this one says it's not an investment. This one also says it's not a good investment if it doesn't fulfill some sort of need. I don't know what that means. It's a little bit vague, but then this one says it can be investment as well as provide tangible benefits. Um, so a lot of these are also a little bit wishy-washy. So the top search result says it's a good thing in the long run. And then if you scroll down, people say, hey, it may or may not be good. This one says it's usually a terrible investment. This one is saying, hey, this is investment despite I'm saying maybe probably the backlash or negative feedback or whatever. And so it's all over the place, right? One thing I do want to mention before we actually get into, let's say, the numbers, is that back 20 years ago, I think the idea that your home was not an investment was kind of a revolutionary idea. So when Rich Dad Poor Dad, I don't know if you've heard of Rich Dad Poor Dad, came out to the scene with the idea, yeah, your house is not an asset, your house is a liability, and it's not really an investment because their definition, because it's purely based on cash flow. So if you buy a house and it doesn't pay you X amount of dollars a month, then it's not an investment or asset. And if spending money to paying, let's say, the bank or the mortgage or taxes or whatever, and you're coming out of pocket, that's essentially a liability. That was the idea why your personal home is an asset. So um, again, there's many perspectives of this, and this is why it's really hard to kind of decipher whether your personal home would be investment or not. Now, given that in society or in the United States that owning a home is part of the societal dream, most people will overpay because they don't do the basic math. And especially as real estate investors, we have to do two things. We have to not overpay and we have to do basic math, right? So we'll just go over a few notes in certain situations. So, and this is, I think, a reasonable definition of a viable investment. Basically, the amount you receive in return is greater than the amount you put in, right? So even if you, let's say, get 1%, which you could probably get by dumping, a good amount of money into like a CD or certificate deposit at the bank, um, that would be a viable investment because it's more than what you put in. Now, if you count factor into inflation, maybe not, but we'll just ignore a few things for now. Um, I think if you compare apples to apples, a lot of people really lose money on many investments because they're not taking into account a lot of things that they can think of. But let's just, ignore that for now. Now, again, let's do a quick review of the Robert Kiyosaki Rich Dad Poor Dad definition. The asset, any asset is going to put money in your pocket. Liability takes away money from your pocket, right? So by definition, any personal home doesn't put money in your pocket unless you're somehow Airbnb it while you're living there or something like that, right? But just for the average person, it's not going to be an asset because they're always paying monthly mortgage, taxes, insurance, and all that, right? So just something to be aware of. Okay, so um, some of the things that we have to do when we're doing the math is also calculate the expenses that we'll pretty much ignore, at least for the first calculation. Taxes, especially this area where I live, is about a couple grand a year, right? Last year it was about 4 grand. Another property I have, it's about 2 grand. Insurance, that's going to cost maybe 1,000 a year, probably 800, 1,000, I think. Maintenance, this is a variable factor that you just have to, a lot of people like to put a percentage, like, hey, I'm going to put away X amount of or a percentage of like the monthly income away for maintenance. You have to do maintenance. All homes eventually, fade away and they need to be maintained or rebuilt at a certain point. Closing costs. So every time you sell a home, you don't get the entire amount of the sales price, because the biggest factor that will take away, the purchase or the amount that you're selling it for is the real estate agent commission, which is 6%. If you do the math on 6%, that's a good chunk of change. So let me just do this. So let's say you have a $300,000 home and you sell it for 6%. You're gonna have to pay a real estate agent 18,000 in commissions, right? That's kind of a lot. Um, so just take that into account. And then also you're probably gonna have to pay uh other fees in addition to the real estate commission. But let's ignore that for now, right? Let's ignore that for now. But just be aware that the price that you sell it for isn't pure profit because there's money coming out. Now, if we're just going to do the math, there's going to be two scenarios that I'm going to go over. So one is a 100% finance scenario. So there are some loan programs out there. I don't have access to them. I think like VA loans and FHA loans. I don't think I have access to FHA loan, or I never applied for one, but you could put down a little bit amount of money, I think 1 to 3% or something like that. And then they'll finance the rest, right? But let's just assume that you're in a scenario where and we're not going to factor into PMI, right? So if you don't know what PMI is, that's actually mortgage insurance. So if you borrow too much, they're going to charge you mortgage insurance just in case you default. But we're going to ignore that for now. But 100% finance isn't really that great. Because yeah, you're borrowing money, but then there's going to be, if you borrow too much money, there's going to be additional costs that you won't have if you don't borrow as much. But okay, so back to my point. Let's go back to the 100% finance scenario. So let's just do this. So we'll buy a $300,000 home, right? And then we'll have a 30-year mortgage at 6% interest, right? I think these days it's about, right now, August 2023, about 7-8%. If you do a Google search. But let's just say we got lucky, lucky this year, quote lucky, 6% interest. In order for me to break even, after 30 years, I need to make more than 300,000. So an ideal scenario is like, let's say you paid $300,000 for the home, and then 30 years later, you have maybe $600,000, or like you're able to sell it for $600,000, right? That's the hope. Now, most people don't really think about this because they don't, just from a financing perspective, right? They don't take into the account of the cost and the interest. The amount of interest you're paying over the life of the loan is not just 6%, right? So a lot of people, because when they sign the paperwork of the mortgage, they don't read all of it. They're actually required by law to disclose how much your interest you're going to pay. So they'll say 6%, and then there's going to be a page that says you're going to pay 100 and something percent, and people just kind of ignore that because, it's like in the movie The Matrix. Ignorance is bliss. I think a lot of people get into that situation. So let's see. Let's just do 6% times. Oh, I already calculated that. So basically, for some reason, because 6% is a low number, the average American thinks that they're going to pay like 18,000, maybe in the life of the loan. but that would be kind of like 18,000 kind of per year, but not really. But let's just play with me here. All right. So I'll just say this is the hoped result to make a profit, because when you do an investment, you want to make a profit. You want to get more out than you put in, right? So that's the idea. So let's say, okay, so here, if we go into Bankrate and get the amortization calculator, you can easily do the math here. So let's say I borrowed 300,000 for 30 years at a 6% interest rate, right? And Bankrate has two sections here. There's a chart, and then there's a schedule. I think the schedule is a lot more useful, but as you can see how much interest you paid at 6% at the end of the loan, right? So 300,000 is the actual loan. You pay more in interest at 6% than the actual loan. So, okay, think of this from the bank's perspective. I loan out 300,000, and then I get this 300,000 back, and on top of that, I'm getting an extra 347,000. That's pretty much 100, I don't know what percentage is, a little bit more than 100% return for the bank. In fact, we could just calculate it right now. So 347,515 divided by 300,000. That's 115% return for the bank, right? So you pretty much would have to pay 215% on your money, right? How many houses are you really paying for at the end of this 30-year mortgage? You're paying for two. You're paying for this 300,000 and then this extra 347,000 at 6%. So if you look at the average American's hope result, they're thinking, okay, if I sell, okay, so they're not doing this basic calculation. So the total that homeowner pays after 30 years equals the home amount plus the interest. So let me go ahead and copy that interest. 347,514, right? And that will equal, oh, I'm sorry. So let's go back here. So that will equal 647,000, right? So even if, let's say, they get excited about their home value doubling, it's not that they need to make more than 300,000 to make a profit. They need to make more than 647,000 to make a profit. So let me just say, so this is the hope result, and I'll just say reality, average American home value needs to more than double in order to make a profit with 100% financing at a 6% rate, right? A lot of people get really excited about their home value doubling, and they think after 30 years, oh, I'm going to make a profit. I made this $300,000 profit. Not really, because you paid more in interest, right? So a home, just considering it from the finance scenario, we're not even taking account to these costs, is a losing situation for your average person unless you pay it off quickly, right? And that's what the whole velocity banking idea is for. Pay it off quickly. Yes, you need the loan to buy the home, but the fact that the idea that you would go to the entire 30-year term, that's a no-no. And refinancing and just extending that loan, which is essentially what the bank wants, that's a no-no too, for the most part. I'm sure there's situations where you'll win, but for the most part, it's a no-no, right? So that's the reality right here. Most people, their home isn't a personal investment from the very traditional sense that when they sell it, they're not going to make double their money if they have their. So the idea for the average American is that if the home value doubles after they sell it, they'll make a profit. But the reality is, if you have financing based on the interest rate, you're probably going to make zero or less than zero. And that's simply why, just for that one reason, financing is the one reason why they wouldn't make a profit on their home. Okay, so let's just take a more common scenario. But in this more common scenario, if we're going to be a little bit more realistic, we have to be a little bit more realistic in regards to expenses. But let's say we have a $300,000 home. So $300,000 home, 6%, no, I'm sorry, 20% down payment, right? And then let's say 6% interest rate. So let's do that. So 20% down payment. So that means we're going to get a loan. Let's just do this. 0.8 times 300,000, $240,000. So 240 loan, right? So let's go ahead into bank rate 240,000, and we'll see that the cost of the loan. So let's just do this. Let me copy and paste this. The cost of the loan is $508,012. So okay, let's highlight that. So now let's say this $300,000 home doubles in value. So let's say, let's say after 30 years, doubles in value will be a $600,000 home. All right, that's kind of good because now we have a $600,000 value minus this loan amount, which is still kind of pathetic, but most people probably think, oh, you know, if it's $300,000 when I bought it and now it's $600,000, I get $300,000 in profit. No. So here we have $600,000, and now if we have about an $80,000 spread, okay. But now let's just take into the account of expenses above. So this spread is going to shrink because if we're being realistic here, we have to take into account the expenses. So taxes, insurance, maintenance, and closing costs. So let's just start off with the closing costs because it's really easy to get an accurate kind of figure for that. So real estate agent, so they say that when you sell a home, you should expect to pay about 9% in closing costs. So 6% for the agent, 3% for the miscellaneous fees. But let me just do this, 600,000 times 0.06. So I would have to pay $36,000 to the real estate agent just to sell my $600,000 home. So that'll eat up into the profit. And let me just do 9%. So let's take into the entire costs. 54,000, right? So if we just add 54,000 to that, let's see, so we'll just say closing costs. Let's see how much money we get. So 012 plus 54, 000, 572,000, right? And let's do this. So let's say that, you know, taxes are $1,000 per year, which is unrealistic because in my area, the taxes were like $4,000. But again, that's dependent on the local county. And then the insurance will be a little bit cheap. We'll say $500 per year. Again, not really realistic because I think the last time I paid these, they were higher than this. But so if we're going to just calculate the amount we're paying in taxes, and I know there's tax deductions regarding some of these things, especially with the interest and all that. But just play with me here. So times 30 years, that's 3,000. So that's $1,000 per year. So we're going to multiply by 30 years to figure out how much we've been paying in taxes. And so that's $30,000 in taxes. right? And then $500 per year times 30 years equals 500 times 30 is 15,000. Are you kidding me? So after 30 years, let's say we lived in it, and again, we're just doing basic math here. So let me just add it up one more time. 508,012 plus 54,000 plus 30,000 plus 15,000. And then we can see that we're not winning. And I'm pretty sure we haven't even taken account of all the fees and stuff because we didn't take into account maintenance costs. But if we just do take into account taxes, insurance, closing costs, we kind of see that even if our home value doubles and we have an 80% loan and 20% down payment at the end of 30 years, we're not making a profit, right? Because the idea of a viable investment is, hey, you put in some money and the amount that you receive in return is greater than the amount that you put in, right? So that's kind of the whole idea of how cash flow would work. Robert Kiyosaki would say like, hey, like let's say I borrowed the whole month of the thing and I get $1 extra on a rental house and I didn't have to do anything. That's like viable cash flow, right? Especially if you borrow 100% money, like it's quote infinite return. Now, again, back to a quote realistic scenario, if we just do the math, right? First of all, a 6% loan isn't a 6% loan. It's 150, I think 15% loan. You have to take into account the closing costs, right? Because you're paying the real estate agent. Now, obviously, if you just decide to do like a for sale by owner or just pay a real estate agent like a flat fee to post on the MLS, then this number is going to shrink, but we're just assuming average American. Taxes, you pay for 30 years, insurance, you pay for 30 years, and then bam, this is how much you paid if you include financing, closing costs, taxes, insurance, yada, yada, yada. So, what have we learned? Now, I'm not going to, put words in your mouth and just think about this. So ask yourself, was this a good investment, especially if you think of it from the average American's perspective? Did this give you more money? Did this give you a return? People are thinking for some reason when they have a loan, even though that loan is at an insane interest, they're making 100 or 200% or 100, $200,000 profit, which they're not. They're losing money, right? And so, as real estate investors, as business owners, as leaders, we have to just do the basic math and be in reality. And a lot of people are thinking if they even though they own homes, why are they living paycheck to paycheck? In fact, I've been watching TikTok videos recently. For some reason, they've been appearing on my YouTube feed about people just like recording themselves how frustrated because they're drowning. And hey, I've been there. If I showed you my tax return, you'd be so shocked from 10 years ago and ask you like, how did I even survive? And to be honest, I have no idea. I would have like the only reason I even thought about like business entrepreneurship or making money or velocity banking is because I was just so flat broke. And so maybe like 10 years ago, being flat broke, even though I thought it was a curse, was actually a blessing because it spurred me to learn about these things. But I feel sorry for a lot of people because they just follow the system and then like I don't know if you ever played the game Lemmings. The lemmings just kind of fall off a cliff and unless there's someone to guide them to another direction, they just end up drowning, right? And that's what's happened to a lot of people in society. I felt like I was going to drown too, and I know I've been there. I've been there many times in my life, so it hasn't been all like sunshine and roses. But there's a certain component to it where yeah, because I was in that situation earlier on in life, I kind of had it as a learning lesson. Okay, enough of me rambling. Um, so uh, every time I make a video, I'm gonna make a plug for our group. So this is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below or send us an email and you can find our email address in the about page of the YouTube channel. And just let us know that you're interested in joining, and we'll send you more information. Okay, have a great day, and we'll speak next time.